Hello, welcome to the UPSC Quick Revision series. Today we will discuss a very important segment of the economy, the capital market. The financial market in any country is divided into two main parts, the money market, which is for short-term funds, and the capital market, which is for long-term funds. The capital market is where governments and companies raise money for a period of more than 1 year. Our agenda for today is as follows. We will understand the components of the capital market, its various instruments, and the role of its regulator, SEBI. The capital market has two main parts. The first is the primary market. It is also called the new issues market because here, companies raise funds directly from investors by issuing their securities like shares or bonds for the first time. The most common method for this is an IPO or initial public offering. The second is the secondary market, which we commonly know as the stock market. Here, previously issued securities are bought and sold among investors. This market provides liquidity to the securities. Primarily, two types of instruments are traded in the capital market. The first are equity instruments, such as shares. When you buy a share of a company, you are buying a small stake or ownership in that company. In return, you get a share in the company's profits, known as a dividend, and the right to vote in the company's decision. The second are debt instruments, such as bonds and debentures. When you buy a bond, you are essentially giving a loan to the company or the government for a fixed period. In return, you receive a fixed interest. This is less risky compared to equity. A stock exchange is an organized marketplace where securities are traded in a systematic manner. In India, there are two major stock exchanges. The Bombay Stock Exchange or BSE, which is the oldest stock exchange in Asia, and the National Stock Exchange or NSE, which is the largest exchange in India by trading volume. To measure the performance of these exchanges, indices are used. The key index of the BSE is the Sensex, which tracks the performance of 30 major companies, and the key index of the NSE is the Nifty 50, which tracks 50 major companies. To maintain fairness and protect the interest of investors in the capital market, there is a regulatory body called SEBI, the Securities and Exchange Board of India. SEBI was established as a statutory body in 1992. Its main job is to regulate the Indian capital market. Its functions include protecting the interest of investors, preventing fraudulent practices like insider trading, and promoting the development of the stock market. In simple terms, SEBI acts like a referee or police for the capital market. Now, let's understand some important terminology related to the capital market. A bull market is a situation where stock prices are consistently rising. Conversely, a bear market is when prices are consistently falling. Insider trading is an illegal activity where people with confidential company information use that information to buy or sell shares. Blue chip stocks are shares of large, established, and financially sound companies. And a mutual fund is a fund that pools money from many investors to invest in a diversified portfolio of shares and bonds. Now, let's test our understanding with some practice questions.